This video will cover the notes on the GAAP conceptual framework for intermediate accounting, Chapter 1. Accounting information has to be useful to users in making rational decisions. It's what we refer to as relevance, that is, usefulness in decision making. But to allow for comparisons across time and between companies, certain standards or common ways of doing things must exist. These standards are identified by GAAP. It represents the set of guidelines for gathering and communicating information about a business, and is sometimes referred to colloquially as the Bible or the Scriptures when it with respect to financial reporting for companies. All companies that are publicly traded, that is, whose stock is traded on national markets, are required to conform to GAAP. GAAP represents the authoritative word on which events should be recorded, when they should be recorded, how they should be measured, what should be disclosed, that is, what information should be provided in addition to the standard financial statements, and how the statements themselves should be prepared, actually what they are and how they should be prepared, the format of them. GAAP has developed over a long period of time. The growth of the corporate form is related to the growth of big industry. In large companies, we experience what we call a separation of ownership and control. That is a separation between those who actually own the company, the stockholders, and those who actually see to the day-to-day affairs of the company, that is the corporate managers. The separation for most companies means that you've got people making decisions about the company, the managers, and spending company resources, who are very far separated from the owners of the company, that is the shareholders. If you own shares in Nike, for instance, you don't know what the company is doing on a day-to-day basis. And so to give confidence to you that things are going well, or at least that you have the information you need to make a decision or decisions about your investment in the company, you need financial reporting that is objective and basically correct and is not hiding things and not changing the way they're reporting things from one period to another. Without those standards, what's to keep management from lying about the company's performance to the owners, the creditors, the government, labor unions, and so on? We experience in corporations, modern corporations, what's called the agency problem. That is, the managers are supposed to be acting on behalf of the owners. But what's to actually keep them from make them do that if, in fact, the owners are separate and don't have the information that the managers have? So part of the development of GAAP is owing to the need to provide owners of the corporation with the information they need to assess the corporation's financial performance and its position and cash flows. The institution of the federal income tax through the 16th Amendment to the Constitution in 1913 also required better record keeping. And so that was another impetus for standardization. The stock market crash of 1929 and the Great Depression that followed and dragged on for almost a decade drew attention to financial reporting and trading abuses. The Securities and Exchange Commission was established in 1933 to enforce the Securities Act of 1933 and the Securities Exchange Act of 1934. Actually, the Securities and Exchange Commission oversees two separate but related activities: the issuance of securities, that's the Securities Act, and also the exchange of securities. There's the Securities Exchange Act coming into play. And so the Securities Exchange Commission enforces reporting requirements and makes sure that companies are providing the information on a timely basis that is necessary for the owners to make decisions about their investments. The accounting profession, desiring to remain free of government dictates, established the Committee on Accounting Procedure, or CAP, in 1938. That was replaced in 1959 by the APB, the Accounting Principles Board, and ultimately in 1973 by the FASB, the Financial Accounting Standards Board. For the most part, these are private sector organizations that take on the task of developing and promulgating and to some degree then enforcing the standards that we know as GAAP. The transition from one entity to another was prompted by attempts to streamline the process of addressing and acting on troublesome issues and to rid the decision-making process of undue influence by one sector of the profession or another, particularly the larger accounting firms or the American Institute of CPAs. So we need to understand that, in fact, GAAP, through the FASB, is really a private sector product. But you have to remember, you've always got the Securities and Exchange Commission looking over their shoulders, and if certain developments occur that the SEC doesn't feel like the FASB is handling, it will instruct them and say, by the way, here's an important issue. You don't want us dealing with this. You want to deal with it yourself. So the SEC, although they're not directly involved in developing and researching and promulgating generally accepted accounting principles, in fact, they do serve an important purpose in at least pointing out to the FASB certain things that they consider to be priorities and putting that sort of influence on the FASB to act on those issues. The FASB issues Statements of Financial Accounting Standards, SFASs, and related interpretations which together establish new or amend existing GAAP. Statements of Financial Accounting Concepts provide the theoretical foundation for the FASB as it addresses new issues. A wide number of task forces and committees are organized to identify issues that are on the horizon, that help to gather information, that help to survey the various interested parties, corporations, the accounting firms and auditors, and the government, of course, to investigate solutions to present to the FASB and to eventually result in SFASs. Other influences on GAAP include tax law, professional organizations like the AICPA or the various state organizations like the ASCPA, the Alabama Society of CPAs, industry organizations, of course, as well. Within recent years, there's an increasing concern about developing accounting standards to produce accounting info that is comparable globally. We have a number of large corporations that, although they may have originated in one country or another, in fact have operations throughout the globe. And so there was a need for a consistent form of reporting, financial reporting, and that's addressed by the International Accounting Standards Board. It was created in 2001, and it promulgates what are called International Financial Reporting Standards, or IFRS. One thing that's occurring now is bringing together the various national organizations and standards such as GAAP, along with the International Accounting Standards or IFRS themselves, to produce what's called convergence. That is, bringing them together so that in fact there's more commonality. We might expect that one day those will in fact be the same. There will be only one set of standards, but that hasn't occurred yet. And so that may be on the horizon. Now, number 7 in your notes, I have not got it in this slide here, you'll see is something I put in fairly recently, and that has to do with the Sarbanes-Oxley Act of 2002. In 2002, the U.S. Congress passed a very sweeping corporate reform act to protect investors from the possibility of fraudulent accounting activities by corporations. Sarbanes-Oxley is named after the congressman that sponsored this act. It's shortened to SOX, S-O-X, and is also known as the Corporate Responsibility Act of 2002. It mandated strict reforms to improve financial disclosures from corporations and to prevent accounting fraud. The act itself was in response to some very high-profile accounting malpractice cases that occurred in the early 2000s. Public scandals such as the Enron scandal, Tyco International, MCI WorldCom. These were big events that made the news virtually every day and shook the foundations of the U.S. financial markets for some time. And so SOX was supposed to address what were perceived as some of the abuses that took place. Among other things, there are two key provisions of the SOX Act, which first of all required that senior management certify the accuracy of the reported financial statements. In other words, that they sort of lay it on the line personally and say that, yes, I personally, in my role, certified that these financial statements are basically accurate. Those are not necessarily the terms that are used, but that's the idea. And also there's requirements that management and auditors establish internal controls and reporting methods on the adequacy of those controls. Section 404 of SFASS had very costly implications, very expensive to establish and maintain the internal controls required. And so there's a real dilemma still that companies face in trying to comply with SOX because of the high cost that it imposes. Besides the financial side of the business, such as the audits, accuracy, and controls, SOX also outlined requirements for information technology departments regarding electronic records. Another thing probably just off that's not in your handout there is that it spoke to, the SOX addressed issues of too great of coziness, too closeness between the auditors that were performing the audit of these companies and the company management themselves. There was a sense in which, or let's say evidence, that in fact, in order to keep a friendly working relationship between the audit firm and the company that was being audited, that the auditors were not as objective as they could have been. They didn't hold the company or take the company to task, and as a result, the companies got away with certain of these activities. This is the end of this particular section. You'll pick up on the second item, or the second video under the GAAP conceptual framework, to continue the notes on the theory of accounting.